Module 3, Financial Statement Analysis. The next piece is going to build on what we discussed for balance sheet and income statement and cash flow statement. And I've entitled this section, Tools for Analysis. These are just that, tools. They help you do something. I'm going to review what I started this section with, is what's the purpose and context of analysis. It's to oftentimes evaluate the historical performance of the company, prepare a forecast for the future, value a company's data, prepare rating or recommendations, or to make decisions. To make decisions as an inside user. So you have to define that context. Who's the intended audience? Is it somebody within the company? Is it somebody external to the company? Is it somebody internally contacting and providing information to somebody externally, or somebody externally looking at the company? What is the end product? What is it that we're looking for? What is the outcome going to be? What is the time frame to do that? What are the resources and constraints that we have when we're doing it? Based on the purpose and context, we need to formulate questions to be answered. So the first step is collecting data, processing data, and then analyzing data. You need to collect data to answer questions, but also to develop the questions. Use analytical tools to process data. We're going to talk about common size financial statements, ratio analysis. Then we're going to analyze the data. We're going to use financial ratios to assess a company's profitability, liquidity, leverage, and efficiency relative to its own past, trend analysis, and peer benchmarking. Okay, and then we're going to synthesize this all together into one place. Okay, so remember, it's the steps that we talked about. One, gathering data, then using tools for analysis, and then we're going to interpret that information relative to the purpose of what we're doing. So that's a brief review of that. And let's start with, again, we went through this financial statement. It's a holistic approach. It's based on fundamentals, what's going on with the business. It's not just about numbers or a formula. Okay? That is the easiest part. Yes, you have to learn that. And that's what you're learning now, is how to determine the common size ratios, trends, and how to do that. But we need to tie in, what does the company do? Where's the company going? What is its strategy? How is its strategy going to impact its financial results in the future? How does it operate within the macro environment that we talked about in Module 1? What are the historical results telling us? And what are the projected results telling us about it? So the first thing I want to start out with is what we call common size income statements. We have the same concept, common size balance sheet, and what it does is it makes things more comparable. We can do this internally, period to period, and we can use and compare it to other businesses and to the industry. So in this example here, we got 3 companies. All of them have $10 million in sales, okay, or 10, 2 million, different cost of sales. It's really hard to compare these, okay. So what we can do is convert everything to common size. And each line is shown as a percentage of revenue. So in this case, we can see the relationship, sales being 100%, and then these are all in relationship to that. So we can determine the profitability, and we can see 20, 15, 20. All of these are giving us more information we can use. Now, I took Destination Excel, and this I previously showed you. This is a income table. I've highlighted the key components. Everybody's is going to be a little different based on your company and what they are, and you can tell it's formatted in millions. But how do we compare these? We can look at these numbers and say, oh my God, things are getting worse. Why are they getting worse? But one of the things you can do is express everything as a percentage of sales. And what we can see, and this is where we're starting to look at this, we can see that the gross margin is essentially flat. So we can then know, based on what goes into gross margin, which is the cost of what's sold, but look at that. We're seeing operating expenses going from 38 to 40, depreciation almost doubling as a percent. But that fits with their strategy of what they're doing. Okay? And we can see some interesting things relative to taxes and the like. But this gives us an ability to compare horizontally and vertically to each other. And this becomes important to identify trends and what to look at a macro basis. We can also put it on a graph, and we can see what's happening with the graph also. So these are what we'll call our common size financial statements. In Project 3, this is what I'm going to ask you to do, is one of the first things is to create a common size income statement for your company. This is going to help us go down this analytical path by highlighting in a very easy way what's going on. This is good information. This is the sounding point. This is when we're taking financial reporting. We're making it more usable so we can fit it on one screen. But now we're looking at it to be able to interpret it. What is it telling us? Same thing with a graph. We can see what's happening. And we could, of course, throw trend lines and such in here also. Ratio analysis. So we got that. That's the first step. Ratio analysis. And the purpose of ratio analysis is to help us better understand the firm and identify strengths and weaknesses. Okay? It's meaningful only within the context of the company's business cycle and the industry. Okay? Very important to note that. Trends are more meaningful than an individual ratio. We can't just take a point in time. We need to look at a trend. What's happening over time? Comparing it to industry averages is also helpful. That way we can see how does our business line up with the industry. That we can look at common size will enable us to do that. Ratios can help us focus on needs. Ratios can help focus on areas where we need to look further. Make us ask questions. That why. You always want to ask why. And when you're done asking why, ask why again. When we move into the analysis of the balance sheet, we're looking at a couple of things. The first thing we're looking at is liquidity. And that's a company's ability to meet its short-term commitments, but it's more about focusing on the ability of the firm to convert assets to cash and to pay for operating needs. Then we have solvency, which is a long-term view, and it looks at the company's financial structure and its ability to pay long-term financing obligation. The tools we use when we look at a balance sheet is common size analysis, which we talked about, and then balance sheet ratios. So as we start out with the balance sheet ratios, and we start with liquidity, and liquid assets are those that are readily converted to cash, as we previously said. They need to be evaluated within the context of the working capital cycle. You're going to hear me say that for the rest of this. The classic one that we look at when it comes to liquidity is the current ratio, and that are current assets divided by current liabilities, which comes directly from the balance sheet. A ratio greater than 1 year would say in a hypothetical situation that if you liquidated all of their current assets, they could pay off their liabilities due within a year. That is the traditional historical definition. But as we're assuming that it's a going concern, Okay, so with a current ratio greater than 1, that means that the working capital cycle has funds to operate, does not have funds to grow or expand. It has to be positive. The more positive it is, the more effective growth can occur. If the ratio is less than 1, that is an indicator that there may not be sufficient funds to drive the working capital cycle. Therefore, the risk of sales occurring and the ability to fund those sales can be at risk. So either way, a current ratio of 0.5 is not good. Okay? And it's not good, assuming that it's a going concern, it's not good because there isn't going to be sufficient funds to make the working capital cycle work. Now, when you're computing the current assets and the current liabilities, you've got to go back and look up what makes them up. Is there something that you should take out that is not really liquid or part of the working capital cycle? And at the same time, is there something that should come out of the liabilities? But that's one you have to do on a judgment basis. But the standard definition, current ratio equals current assets divided by current liabilities. Keep in mind, though, 1 is an important metric from both the classical definition and the going concern, working capital. The next liquidity ratio that we're going to look at and have already is the cash conversion cycle. You did that in Module 2. There's a little bit of a twist on that, and it's the inventory turnover ratio, and that's cost of goods sold divided by inventory. Indicates how many times inventory turns over within that year. The faster the turnover, the greater the liquidity you have, because you can liquidate these assets faster, and that's more easily converted to cash, and less risk of obsolescence. Okay? And the converse is also true of that. But it's important to understand this inventory turn within the context of the cash conversion cycle and the business. Type of products in the business enter into this all of the time. For example, fresh fruits and vegetables should turn very fast. In fact, everything in a supermarket should turn very fast. Okay? And it should turn fast on fresh fruits and vegetables because the physical life of those is very short. On the other hand, jet planes, a manufacturer of jet planes or turbines, is going to turn much slower because they take longer to build. So you got to look at that within the context of what's going on. So those are your liquidity ratios. The next thing is our asset efficiency ratio, and they measure how efficiently the firm is managing its assets. It can help us understand the question, does the amount of each asset type seem reasonable, too high or too low in view of current and projected sales? Once again, it relates to the working capital cycle. If a company has too many assets relative to its working capital cycle, excess working capital, it's depressing its earnings because whenever you're using funds you don't need, it's costing. There's a cost associated with that. The company has too few assets relative to working capital, it's going to be missing sales because it can't keep up with them. Now, the cash conversion cycle is good measurement. You've already been working on that. It hits the cash conversion cycle is a very good measurement. It hits accounts receivable, inventory, and accounts payable as they relate to each other and not independent. We want to make sure we're tying this together and not just looking at one of these things in isolation. It's the relationship that becomes most important. Independent measures will allow for some industry comparison. Inventory turnover, we can compare industries to see how that turnover ratio is. And we talked about that's cost of goods sold divided by inventory. Return on assets, net income divided by assets. Return on equity, net income divided by average equity. So those are our asset efficiency, our liquidity and asset efficiency ratios. So that's the asset side of the balance sheet. Let's take a look at how that works with Geneseo Coffee Company and Destination XL. Let's let's take a brief look at Geneseo Coffee Company to see how these numbers stack up for them. What I've done is I've started with the current ratio, but I've built this model, and the one that I've used for Destination XL, I've built it based on my source documents, my financial reports. So what I did is everything refers back over to the basic financial statements as we saw with free cash flow. So now when we look at this, current assets, $1,460,000, $950,000, and $700,000. So what I did is I referenced that back over to financials, C9, and we now can see all of them. So there's our opportunity to get that information. We bring over liabilities the same, and we can see that their current ratio is strengthened. Now, if you look at that, let's just put this traditional looking at it, that yes, there's enough money that if they liquidated all of their current assets, there would be plenty of money left over to pay the current liabilities. Okay? And it was important to note that, because that's what it is theoretically. However, what it's telling us is they have sufficient information to be sufficient working capital, current assets, to be able to support the working capital cycle and to support the growth of the company. What we saw between 2013 and 2014 is we saw it decline, okay? But we also saw them change and do some capital structuring in the year 2015, which improved that. So it gave them funding to be able to move forward. We look at the inventory turnover. Again, where did we cost of goods sold? Right from the financials. Inventory, right from the financials. And then we calculate this ratio here. Now, I'd suggest in that when you're doing this, you want to do the same thing. Build it off of the 10K. Return on assets, net income, which we picked up right over here. If we looked at C42, we go over here. There's C42, so we bring that across. Okay. Assets, same thing. So we can determine the return on assets. How efficiently are we using our assets? Now remember, some of this is the intent is to give us information that we will subsequently analyze. Okay, so we're going through this methodical process. Next one is when we come to return on equity. What we're seeing is net income. However, since they issued preferred stock, we're trying to determine return on common equity. Okay, so I'm going to actually just put that in there right now to make that real clear. Common equity. Okay, so we subtract out the preferred dividends that were paid. And now, sometimes companies give us an average balance sheet. Okay, most of them don't. So if we want to figure out what the average common equity is, because it's a return on average common equity, we start with the beginning of the year, and then the end of the year, take the average, and divide the net income divided by the average common, and that gives us our return on equity. Again, this is how we're going to interpret this. And this becomes more as we move forward into capital structure, which we'll talk more about as we move forward. So that's Geneseo Coffee Company. And let's take a quick meander over to Destination XL. Same thing. I built it based on a model. So again, I put in my, right here, I put all of my financials. I started by bringing in my balance sheets. I've brought in my consolidated statement of operations and my cash flows. So by bringing that in, what I was able to do is every one of these data elements are sourced back through another worksheet to the 10K. So we always know where our numbers are coming from, which reduces errors. It also makes it very efficient when you're modeling to simply cut, copy, and paste. So this is all a calculation. We can see that the current ratio has declined fairly rapidly. This is one that we're going to have to take a look at. We're seeing a slight reduction in the turnover. I want to look at that. Obviously, they've had a loss. That's part of the strategy, though. So that's what we're going to do is first compute. Remember, we've got our data. That's this. We're now taking that data, And we're doing analysis on it, as we have with our sales analysis, what we've done with our free cash flow, our cash conversion cycle, and working capital. We're gathering the data. The next thing we're going to take a look at are what we call debt management or solvency ratios. But before we get that, I need to define out what leverage is. Leverage is the extent to which the firm uses debt financing or financial leverage. If the firm earns more on its asset than it's paying on its debt, then it's using the debt to leverage or magnify returns on equity. By using debt, stockholders can control the firm with a limited amount of equity. Creditors look, on the other hand, to equity to provide a margin of safety in case something does happen. It also, equity allows the firm to absorb losses. But the key is the definition. A firm wants to use leverage so that if it can borrow at a lower cost, buy assets, utilize assets, and produce a greater return on those assets, that's leverage. When we look at debt management solvency ratios, and this is, it looks at a point in time and looks at the relationships between the debt and equity, debt and assets. So there's 5 of them that are classical that we look at. One is long-term debt to equity, which is total long-term debt divided by total equity. The debt to equity, total debt divided by total equity. Total debt divided by assets. Debt to capital, total debt divided by total debt plus total equity. And then the total assets divided by total equity, which is our financial leverage. For the most part, the ratio, the calculation is implicit in its name, as you could tell here. Generally, the greater the debt of a company in the capital structure, the greater the financial risk and the less solvent they are. Okay? For this class of ratio, a higher ratio indicates a weaker capital structure or solvency. Generally, the total debt, known as debt to assets, can be found directly on the company's financial statements when we look at it. And the one that I prefer to look at, and one that we're going to focus on here, is this financial leverage. And this oftentimes is just called the leverage ratio, and it measures the amount of assets supported for each dollar of equity. For example, a value of 3 would mean that for each dollar of equity, it supports $3 of assets. The higher the financial ratio, the more leveraged the company is in the sense of using debt and other liabilities to finance assets. This ratio is often defined in terms of average assets, and we need to be, again, careful for that. But for assets, we generally use the same thing. And so we're going to focus, as much of all of these are important, and you should know that there are different definitions. The ones that we are going to look at is our leverage ratio, total assets divided by total equity. And then we're going to look at our debt to equity. That's telling us our relative utilization of debt relative to equity. So we're only going to look at these 2 when we move forward, but I wanted to share them. So this is the measurement of a point in time of how a company uses debt and how solvent and what's the relationship between equity, debt, and the assets they support. Remembering that we want leverage. Leverage is the ability to earn more on our assets than we pay on our debt. So we got to find that balance. And we're going to talk about that a little bit more in the capital structure. The next type of debt management ratios that we have is the ability to repay. Okay? How are we going to pay back the debt? Okay? Now, this becomes a critical thing that a lender wants to know, if a company is issuing a bond, a public security, people want to know, how am I going to get paid? What's my coverage ratio? So there's really a couple things we look here. We evaluate the capacity to repay. There's two basic ones, and these are used, believe me, all the time. I'm working on a deal right now as we speak that the cash flow coverage is probably the most important thing all of our lenders and participants in this project are looking at. The first one is our times interest earned, which is EBIT divided by interest expense. So you say, what is EBIT? Well, earnings before interest and taxes. Okay? Because out of the earnings before interest and taxes comes the firm's ability to pay interest. What is EBITDA? Earnings before interest, taxes, depreciation, and amortization. So when we look at our cash flow coverage, how much cash is going to be available to pay back the current debt and interest? Okay? How many times is the cash flow covered? So how much does operations generate to be able to pay back the debt service? That includes both interest and payments. Let's stop and take a look at how that applies in our situation. Let's take a look at Geneseo Coffee Company on their debt management and solvency ratios and their debt repayment capacity. So the first thing we're looking at is the leverage ratio. That means how much of the assets is supported by equity. Remember, the greater this ratio is, the more highly leveraged the firm is. So again, right from the, as you can tell right here, right from the base financials, I want you to do the same thing. So my leverage ratio, as you can see, they have had added equity. They've added equity through retaining earnings and by issuing preferred stock. And what they've done is they've deleveraged the company, if you will. But that's saying that for every $2.25 of assets, there's $1 of equity behind it. We look at the debt to equity, $700,000 long-term debt, total equity, so 69% debt to equity. So that gives us the capacity solvency, and they're probably fairly capitalized at this point, but when we move into capital structure, we're going to see that sometimes you want to increase leverage to become more profitable as a company. But that's when we get into different aspects of modeling. When we look at the debt repayment model, earnings before interest and taxes, net income, we add back the interest, add back taxes. Last year there was a benefit because there was a loss. So there's EBIT. So now, when we look at this, the interest was 38, which came directly from right from the income statement. Okay? So we put that in, and we can see that EBITDA was able to cover interest 9 times. So that means there's sufficient income to pay the interest. There wasn't in the prior year because there was a loss. Remember, we're looking at trends, okay, and point in times. Like that would be a red flag to a banker at that point. So then we move on is what's our debt coverage ratio? Not just how much have we had earned to cover the interest, but how much cash flow is there to cover the debt service, which is principal and interest. So we start with EBIT, we bring that down, and the adjustment is depreciation and amortization. So we add that back, and that gives us EBITDA, okay, $425,000. Current portion of long-term debt is the interest and long-term debt right here, which is on the balance sheet. So now we come back and we say they had earnings cash of $425 to support $138 in debt payments. That means they had a cash flow coverage of 3.08. So that for every dollar in debt service, principal and interest, there was $3 in revenue. That's good. Okay? You're looking at today 1.5 minimum, but but most banks and financing companies are looking for 2 to 3 to 1 coverage. So again, this would not have been a favorable situation right here. So that's our ability to, we're starting to evaluate the capital structure. Okay, and if we go right over to destination, we find the exact same thing. Again, it's all built from the 10K, okay, or bringing it down. So the formulas all work through, so I could always trace back. And as you can see, this company is put on leverage. Now the question always becomes, when you start asking this, is what's happening with this leverage? What's going on? Is it good or is it bad? Now, as we said, their strategy is to open up more Destination XL stores, which are bigger, okay, and close the smaller stores so they can improve the long-term profitability. So they've done that by funding the company using debt and the losses as they've transitioned to do that. So this is a increasing leverage, and this is confirmed by both. Here we can see that a lot of equity went away as they were doing this transition. So this is one that we want to examine. Next is our debt repayment capacity. Can we repay the debt? And in all these past 3 years, what we see is because of the losses, even when we add back interest and taxes, we can see that they don't have enough cash flow to support interest payments. So then the question is becoming, where is that money coming from on an income basis? Because income doesn't generate enough income to pay the interest, which is never a good sign. However, when we come down one more step to find EBITDA, we start with EBIT, and we see that depreciation and amortization is pretty big. And we've seen that it's increased. So when we look at the current portion of long-term debt and interest, we see that we now have a coverage ratio of 2. So that's not too bad at all, but you can see we're struggling in these 2 years. These years was actually pretty good. Okay, some of it caused by the variation in taxes. So now that's our debt capacity and our coverage ratio. So again, we've taken this raw data down here from the 10K. We started putting it into tools. So we're building ourselves going forward from tools, and then the next step is going to say, how do we take all this information and do something? The next thing we're going to take a brief look at is our equity ratios, and not within the context of our... Next, we're going to take a look at our equity ratios. And some of these are dividends, what the dividend yield is, the dividend that is paid by a company divided by its price per share, current market value. Then there's the dividend payout ratio, total dividends divided by net income. Then there is tangible equity, and that's total equity less intangible assets. So these are important to look at as we move forward, but right now we're not going to go in and calculate any of these. Now, when we move on to the income statement, we really are starting out with our common size income statement that we previously talked about. And you can create different ratios, and the most important one is our gross profit margin, which we saw on the common size. And we can also see the net profit margin. So really our common size statement gives us the basics that we need. Everything is about profitability. So we want to look at where the profit is coming from. So these are all important measures. They are all on your common size financial statement. So we don't need to look at those. What we do need to look at is trends. Trends are most important. We will look at sales trends expressed as a percentage over a period of time, year to year, quarter to quarter, same quarter, which takes into effect seasonality, and then compound annual growth rates. Now, we've already talked about that and looked at that. When we look at the net margin, equals net income divided by revenue. Net profit margin measures the amount of income that a company was able to generate for each dollar of revenue. The higher the level of net margin, the higher the profitability, which of course is better. Also, we oftentimes referred to as return on sales, depending on what your company measures. And in the retail business, it's oftentimes a return on sales. And you're going to actually see that that's pretty low. Gross margin, net sales, less revenue, less cost of goods or cost of revenue, equals net margin expressed as a percentage of sales. We got that in the common analysis. But what this does is it enables us to evaluate sales growth in connection with the underlying costs. We want to take a look at non-cost of goods sold, often expressed as revenue. We've talked about this in the previous section on that, but this is about how do we analyze it. So these are tools. What we did talk about in income statement is really some of the tools. We then move on to some profitability ratios, earnings per share, how much did each share of stock earn? Simple formula is net income divided by outstanding shares. And that there's really two PEs, primary and fully diluted. Primary are those that are outstanding today. Fully diluted shares assume that all stock options, warrants, etc. are exercised. And that would increase the number of shares. And that's generally less than our earnings per share. So we have the profitability ratios. And these we are going to take a look at. Pricing ratios, PE, price to earnings, which is the current price of the stock divided by the earnings per share. You already calculated that in previous project. It can be expressed based on the past quarter or the past year. When it's historical, it's referred to generally as the historical PE. The forward PE is based on projected earnings. And Wall Street analysts project earnings, and that's available to you on the Wall Street Journal site. A number of other places will get it for you. And or it's provided by the company. The higher the PE, the more the market values that stock or sees growth continuing. There's other price to ratios, price to sales, price to book. They're all different ones. The one that we're going to really focus on is the PE ratio, as you'll see that moving forward. Okay, we do all this stuff. Now what? Well, it really is now time to ask questions. To stop, we've done the numbers, ask questions. Understand what's happening with the company. What's the relationship of revenue to profit? Then we're going to look, how do you apply that to the future? And what a financial analysis is, when you look at a financial analyst report, they cover the following. They're going to put in a summary data and recommendations. They're going to have in a price chart where they think the price is. They're going to talk about the business, the summary. They're going to talk about the financial highlights. They're going to talk about the investment rationale, why I'd like to be involved in this. They're going to analyze financial metrics in the financial summary. And that becomes the basis for their recommendation. Now, as I've said in the beginning, financial analysis, it's about critical thinking. How do we go deeper? It's not just calculating the numbers. I know you can do that, and you're going to do that. But it's about how do we think? How do we interpret this data? And I'm going to keep pushing you to go deeper and develop a logical analysis. And I'm going to try to break it in enough segments so that we can focus on making sure you understand how the mechanics work. Once you do that, then we're going to push you very deep. You need to always be asking questions and drill deeper until you've uncovered everything. Presentation and communication of your analysis is critical. Readers need to digest things quickly. Then this type of work results in financial decisions that can be made, and it continues to be interactive. Let's just take a brief look at pricing from the perspective of almost to the end of this segment. I know it's a little long, but I wanted to keep it together. These are the tools. We're covering an awful lot this week. This week is going to be really intense as we're at the halfway point. So when we go to calculate tangible net worth, we start with total equity, which we bring down simply from above. There's our, right here, our equity. We bring it down. And now we say, where do we find intangibles? Well, if we go to the balance sheet, we know that that's on the balance sheet. And intangible assets, okay? And these are intangible, so there's nothing physical with them. So what we do is we take them off, and we could see that the difference between total equity and tangible net worth is actually pretty small. But this will help us understand that there's not a lot of intangibles. When we look at some companies, you're going to find that there may have positive equity, but when you take out the intangible, there's negative. An example of that is Valiant Pharmaceuticals. Now, when we go on to the price to earnings, what we can see is it's $4.87, which I got right from the Wall Street Journal. And the historical earnings, which I got from the 10K, are negative. So the number, even though mathematically it comes out as negative, we would call that not meaningful. Okay. So now we want to take a look at what are the forward earnings. And when we look at the consensus estimates, that they'll make 13 cents this coming up here per share. So that's a swing from 17 cents loss to 13. So the forward peg is 37.46, which is still high, which indicates this is most likely a growth stock. And it is, and the market has expectations that the strategy they're engaging in will work. So that brings us to the end of tools. What you need to do next is we're going to review the assignment number 3 and this coming up week.